Vic Joshi, C2 Financial, home of free mortgage consultation. Let's talk a little about interest rates, how interest rates are given, and how the market moves on rates. And we'll talk a little bit about locking interest rates, which is something that a lot of people are confused about. So, first of all, mortgage rates move daily. And sometimes they can move up to 5 times a day. I've seen interest rates move as much as 1% in a single day in an extremely volatile market. So when people are looking to shop for rate, especially if they're looking online, they're looking at data that's constantly shifting. So a lot of times what you're seeing online may be stale information, and that online rate information is really geared towards enticing an individual borrower to apply for a mortgage with a particular lender, or through an entity like LendingTree or something else where they have a number of lenders that compete for the business. The problem with that is that any lender or any marketing entity who is allowed to quote interest rate can quote anything they want under the guise of estimate. And those quotes are not necessarily being updated in real time based on how the market is moving. To complicate things further, even though the market might be improving on rate, certain lenders will artificially worsen their interest rates or make their rates better based on how much volume that they feel that they can handle. So sometimes an advertised rate with a particular lender, by the time you get to the application process, if that lender is inundated with volume, they may actually make their rates worse even though the market is improving. Let's talk a little bit about what sets interest rates. Interest rates are set primarily by the yield, or the rate of return that bonds provide. If you're tracking mortgage rates, you primarily want to track the 10-year Treasury and you want to track the 30-year bond. And as the yield, or the rate of return on those bonds increases, then mortgage rates will increase. And as the yield decreases, mortgage rates will decrease. That is a direct correlation. Some people are confused into thinking that the federal government, the Federal Reserve, actually controls mortgage interest rates. Federal Reserve does not control mortgage interest rates. The Federal Reserve controls one rate of interest. It's called the Fed funds, and the Fed funds rate of interest is the rate of interest that the federal government gives to institutional banks for overnight lending. So when an institutional lender is short on funds, or institutional lenders, institutional banks will sometimes manipulate the Fed funds in such a way that they can borrow from the Fed on the cheap overnight and invest that money in some other higher return vehicle, that is really the only rate of interest that they control. The Fed funds currently is at 0.5%. Prior to December of 2015, the Fed funds have been at 0.25% for close to 7 or 8 years, which was historically low. The Fed started increasing the Fed funds rate in December of 2015, and we're 0.25% higher right now at 0.5%. There is one mortgage rate that affects, and that is home equity lines of credit. The Fed funds rate of interest affects revolving lines of credit, such as credit cards and home equity lines of credit. Prime is that rate of interest that directly correlates to these revolving lines of credit, and prime is always 3% more than the Fed funds. So currently prime is at 3.5%. You'll notice on your credit card statements that the credit card interest rate is usually prime plus some percentage, and that could be true for home equity lines of credit where the rate could be prime, it could be prime plus 1, but that is really the only mortgage rate that the Federal Reserve directly manipulates or impacts. The bond market impacts the rest of your mortgage interest rates. So back to how rates are given. If they are changing every day, every lender for every loan product offers a different spread of interest rates every day. I'm going to speak in hypothetical terms. There's one terminology that I need to address, which is called points. Now, you may or may not have heard this term, points, but 1 point is the equivalent of 1% of the loan amount, and it can be either a cost or it can be a rebate, depending on where in the rate spread that's being offered that you're looking at. So the higher the rate in the spread, the larger the rebate in points that the lender gives you, and that rebate will be applied to offset your closing costs. There are costs and fees associated with taking out a mortgage, and the rebate points can be used to pay for those. If you go lower in the rate spread, the lower you go, the higher the cost in points. So 1 point being the equivalent of 1% of the loan amount, if you are going lower in the spread, you're paying points to buy down that interest rate, and that's going to add to your normal closing costs. So in a hypothetical spread, let's say the spread is between 3.5% and 4.5%. These are not real interest rates, by the way. I'm just using a hypothetical scenario. If the spread was between 3.5% and 4.5%, the 4% interest rate would be the 0-point rate, the median rate, where the lender is not charging points, nor is the lender giving you a rebate in points for that rate. If you go higher in that spread, let's say you go to 4.25%, then the bank will give you a 1-point rebate, which is 1% of the loan amount as a dollar amount that will be applied towards paying your closing costs. And conversely, if you were to go to 3.75% in that hypothetical rate spread, the lender would be charging you 1 point, which would add on to your closing costs. So that's just a general ballpark idea of how interest rates are given. There's another issue, which is locking an interest rate. Since the market is constantly moving, in order for you to secure an interest rate, you'll have to come to terms with the lender and agree to lock in on a specific day. When you lock in that day's rate, you're actually locking in the entire rate spread for that particular day. So even if you said, I want to be at 4% for 0 points, and you tell your loan broker or loan officer to go ahead and lock that rate, they will lock 4% at 0 points, but the reality is they're locking the entire spread for that day. So at a later date, prior to closing, if you decide you'd rather go to a higher interest rate and get some rebate, you can do that, but it'll be based on the date that you locked in. You will not be able to get whatever the current market is if you've locked in. When you lock an interest rate, you're typically locking for a set term, 15, 30, 45, 60, or 90 days. The most prevalent lock period is a 30-day lock, but when interest rates are low and the market is inundated with volume, then many lenders require you to lock in for 45 days or longer. The longer the period that you lock in, the more in points you're paying for the same interest rate in the spread. If at the 4% interest rate for a 30-day lock it was 0 points, if you lock for 45 days, you might pay a 1/4 point in order to lock in for 45 days. You do not have to lock in an interest rate until you are getting close to needing to get your final loan documents in escrow so that you can close a transaction, because a lender has to have a fixed locked rate and point structure in order to generate final loan documents. So you can float the interest rate while you're in process throughout the process until you get within a few weeks of closing, and then you have to figure out what rate you're locking in at and what point structure you're going to go with. Those are all things that I will help you with. That's all part of my process in educating and giving advice as to when to lock and when not to lock. But remember, when you lock in interest rate, if the market improves later in the process, you cannot go to that later date. So the lender will allow you to get an improvement on the interest rate and points after you've locked in your rate, but only if the market has improved significantly. And significantly is arbitrary based on each lender's policy. Some lenders will require that the points improve by 1 full point, and then they'll give you half of that, and they'll improve your points by a half. Other lenders may require that the rate improves by a 1/4%, and then they'll give you half of that, which is an 1/8% improvement. So locking in the rate doesn't mean that you can't capture a better market rate in the process, but you will not ever get back to market while you're locked. You will have to split the difference with the lender somehow. If you don't lock in, obviously you're fluctuating with the market, and when you do finally lock in, you're going to get whatever the market is bearing on that day. The nice thing about locking is that if the market gets worse throughout the process, you are not subject to that worsening market because you'll have locked up your rate. And so you can keep your rate and point combination as long as you can close the transaction before the lock expiration date. Since lock expiration dates are finite at 15, 30, 45, 60, 90 days, depending on which lock term you lock in for, you do need to get your transaction closed within that period of time. If you get to the end of that lock period and you haven't closed, then you'll be faced with a choice to either extend the lock, which may cost you in points, or to let the lock die and wait to reset to market. And it'll take usually about 30 days for you to wait to reset to market before the lender will allow you to get the reset and go back to current market rates. Locking is kind of complicated. That's why you need to have a good consultant to help you walk through the process and to give you advice on when and how to lock. But a general rule of thumb is that if you see the rate and point combination that you want, lock it, because doing anything else is gambling. And interest rates will tend to increase faster than they will decrease. Where rates can go up 1% in the matter of a few days or a week, it may take rates to then come back down to where they were and lose 1% over the course of weeks to months. So be aware that that is how the market reacts, is that when things are going negative, it goes negative quickly. And when things are going positive, it just stretches and takes longer for you to get back to where you want to be. Not locking is gambling. Hope that helped understand a little bit about how interest rates are given and locking rates and the ramifications of that. Again, feel free to contact me at any time for a free consultation, and I can explain in more detail all of those issues. Vic Joshi, C2 Financial, home of free mortgage consultation.